Okay, so we are gonna give it a start. So hi everyone, this is Finance Meets Real Estate. As you guys know, we meet every Tuesday, 6:30 Eastern Time. We have an incredible guest here today, Spencer Gray from Gray Capital. It's a real pleasure to have him on the show. He's been involved in, it's a, it's hard to say, like over 1.5 billion of real estate transactions, 500 million of assets under management. He also has and he's going to talk today about raising capital from family offices. And he also, besides Gray Capital, his real estate investment collective, he is also the CEO of a commercial real estate focused family office himself. So he has 16 years of experience in various real estate investing strategies. And before that, he was a recording engineer and an audio book producer, eventually selling his company, like a hop brokerage in the Midwest. So it's quite an interesting background there. I'm very excited to hear like his talk. I have we have had like few people talk about family offices, so I think it's going to be a very interesting topic as well. And with that, I'm going to pass it on to Spencer. If you guys have any questions, feel free to put them in the chat, and we're going to do like a presentation, then we will have a Q&A at the end. So feel free to put your questions in the chat, and in the end, we're going to open up the floor for more questions. But then I'm going to pass it on to Spencer. And again, pleasure to have you here, Spencer.
No, I really appreciate you inviting me on, Stefan. This is a really pleasure to be here, just be here live with all of you. You know, so often doing podcast recordings, it's not live, so it's awesome to actually have people who can ask questions. It's just a lot more of a dynamic environment, and I really appreciate you asking me on to speak on this particular topic, because it's something that when I speak to a lot of other, syndicators or real estate investors, folks who are raising capital for, whatever project, the whole concept of raising money from family offices is incredibly intimidating because they're very closed off, and I'm going to speak to some of the challenges. But like anything, it's just a matter of taking the right strategy and the right approach and pursuing it. I feel as though so many in the capital raising space, real estate syndicators, do not look at the option of networking with family offices and having a specific strategy to pursue relationships with family offices. And I think that could be a big mistake because they can be a great partnership for the long term to really build, whatever you're looking to build, whether that's real estate syndication, other type of venture capital, private equity, whatever it may be. It can be a very powerful partnership and tool. And so, just with that being said, I'm just going to hop right into the presentation itself. And as Stefan said, please feel free to ask questions anytime. I'm going to be doing my best to look at the chat window, although I guess I shared my screen, it went away. But if Stefan, if you want to shout out any questions, let me know. Or if we want to wait to the end, that is absolutely fine as well. So my name is Spencer Gray. I'm the president of Gray Capital, LLC, as well as the president of Gray Properties, LLC. But really, before talking about myself, and I'll get into my background a little bit, but want to talk about today, really, again, why family offices and multifamily offices, and we'll get into the differences between those, and the challenges associated with getting in touch with family offices, networking with them, and finally, building that relationship and trust to actually do a deal with a family office or a multifamily offices. And then, because I think it's such a big difference between the single family office and the multifamily office, and then multifamily offices run by families or family offices, and multifamily offices run more of as a real estate or a registered investment advisor. There's quite a bit of differences, different strategies, and I don't think too many people are aware of the options of working with maybe a multifamily office in addition or instead of a single family office. And then I want to talk to just about strategies, the way you can actually access these family office networks. Some of these are going to be pretty obvious. Some of those, may not be, because there are outlets. Again, if this is a strategy you want to intentionally pursue, there are groups, organizations, and networking events that are all centered around family offices that family offices attend with high frequency. And then just a little bit about how to structure a deal with a family office. And one theme that you'll discover throughout this presentation is family offices aren't inherently different from any other investor. They don't have to be. They certainly can be, but not always. And again, the underlying idea is that you shouldn't be intimidated to pursuing a strategy of working with family offices. So again, just a little bit about myself. Really the firm Gray Capital. And maybe before I talk about Gray Capital, just as Stefan kind of alluded to and mentioned in my background, is I don't have your kind of typical finance or real estate background, although I really started my career after high school investing in real estate, flipping houses. I really kind of partnered with someone who else that was in the real estate investing space just prior to the great financial crisis. But then I kind of pursued a career in a variety of different things, tried a couple different things out until I came back to real estate. I went to music school at Indiana University, worked as a recording engineer, audiobook producer, musician, till I realized I really couldn't make a living doing that, or wasn't doing what I really wanted to do. I got into the craft beer industries, brokering hops to craft brewers, working with farmers out in Yakima, Washington and Oregon. We ended up being the largest hop brokerage firm in the Midwest. Sold that company in 2015, and looking for my next endeavor, I kept focusing on real estate, as that was a constant in my career. I'd always had some kind of real estate project going on in the background, and I decided my next business I wanted to focus on real estate investment. So first, in 2015, I founded Gray Capital with my wife, Alex. We're headquartered in Indianapolis, Indiana. We target existing, stabilized, large multifamily assets, typically 100 units and above, typically value-add, core plus strategies, again, mostly in the Midwest. And by the end of this year, we'll have gone full cycle on at least 10 syndications since we started in 2015. And we're proud to say we control over $500 million worth of real estate, but we've participated in over $1.5 billion worth of real estate transactions since 2015, whether that has been as a lead GP, co-GP, or a limited partner in the project. And then kind of the newest thing from Gray Capital is we've launched a $100 million equity fund, the Gray Fund, targeting kind of the same strategy, existing, stabilized multifamily assets, value add and core plus throughout the Midwest. And there's the Gray Fund. The other project that I have been pursuing is a little bit after my wife and I founded Gray Capital and started syndicating multifamily projects. I teamed up with my father, my brother, and my uncle, and we founded, not intentionally, but we founded a company called Gray Properties, with the idea to invest passively as well as a co-general partner, passively as a limited partner as well as a co-general partner into real estate syndications in a variety of asset classes. But the idea was to really be more of a passive investor. And as we kind of pursued that and networked with syndicators and operators, operators started referring to us as a family office. And at the time, I had never heard the term family office, but it seemed to really lend us at Gray Properties, at least, quite a bit of credibility. A lot of syndicators started really wanting to work with us, offering us different types of opportunities and projects. And so we kind of continued with that label of a family office, albeit Gray Properties itself is really only focused on commercial real estate, which I would say is not unique to family offices, but different than your typical family offices that focuses on a variety of different asset classes beyond real estate. In Gray Properties, again, we've invested in multifamily, industrial, medical office, quite a bit of farmland, a little bit over 40 assets in the portfolio. And as I mentioned, we've pursued LP positions, primarily co-GP positions as well as some JV equity investments itself. I would say that most of my time now is spent on great capital. Great properties is more or less a passive vehicle, but we still do make allocations from time to time. All right, so why family offices? What's the point? Because there's a lot of other options if you're pursuing a syndication or raising capital from investors. Really, the classic way is called the country club method, which is really going to family, friends, maybe an institution, and that may be the closest form that relates to raising money from capital from family offices. But it's still different. And so a typical way a syndicator raises money today, or at least is what you see on LinkedIn or on YouTube, is you're raising capital from a lot of different limited partners, mostly accredited, high net worth individuals, not necessarily ultra high net worth, but typically high net worth, and you're raising $50,000 at a time up to $100,000 at a time, which can be great and it's a good strategy. A lot of people have been very successful at that, but it takes quite a bit of investors investing $50,000 per project to build up enough equity to take down a larger project, especially the types of projects that we at Gray Capital pursue. Again, typically 100 units or up, kind of average project size, really in the $40 million range. The smallest project we really look at is around a $15 million. And we were bidding on a $165 million project or portfolio this week. So if you are looking to scale, if you're looking for long-term strategy to raise capital to acquire assets, you need to have at least one, ideally multiple long-term programmatic partners, and that's what a family office can really provide. They may not provide 100% of your capital, but they can be what we call an anchor investor or several anchor investors that make up the majority or at least a plurality of your equity capital stack. And so being able to form a relationship where you can more or less count on a decent sized check deal after deal can be incredibly powerful. One, from achieving the end result of raising all the equity that's required to close on a project, but also for us, it's having the confidence that knowing that you have backers and equity partners that can step up and write a big check, and having a relationship. And our case where we have a relationship with several family offices where if we ever have a shortfall for whatever reason, they can step up and fill that gap if it was required. So obviously the large check sizes can be appealing. And as I said, not every family office is the same. Some family offices, like a typical limited partner investor, may want to start slow with a new operator and may only want to invest $100,000 or call it $200,000 just to test the water and see how the relationship goes. Many other family offices, they're not going to make an investment unless it is worth their time and it moves the needle. And as you'll see later, the average net worth of most family offices is around $1.5 billion. So a $100,000 investment for someone who has a net worth or a family who has a net worth of $1.5 billion probably isn't going to move the needle and is not worth their time or energy to really to fill out the private placement memorandum or subscription documents. And so they're typically trying to write a check that is at least meaningful to them. And so in my experience, that's typically at least $500,000, but it can be all the way up to, really the sky can be the limit. But we speak with family offices that typically can write, $5, $10, $20 million checks and more. And so again, that can be a very powerful tool when you're looking to scale your syndication or capital raising business. Many can be very flexible. Some can be stringent. Again, there's every family office, like every personality out there. But often you're dealing, again, not always, but often you're dealing with a relatively small group of individuals, maybe an individual, and you're dealing directly with the decision maker often. And so they typically can have a little bit more flexibility compared to a private equity partner or your typical joint venture equity agreement. In general, I would really look at a family office relationship as an alternative to pursuing a relationship with a joint venture partner or private equity partner. Not that they can't really mirror themselves, but we've seen family offices just being a little bit more flexible compared to your typical private equity or JV partner. I also think it lends credibility. Once you've done a deal with a family office or several family offices, I think that lends some credibility, to your abilities, as typical most family offices have some sort of stringent due diligence process on the operator themselves. And as is the case with just any limited partner in an investment, word of mouth and proof of concept and social proof is incredibly powerful. And so if one family office tells their family office associates that they're investing with you, you can really snowball much quicker, because instead of snowballing investors who are investing $50,000 at a time, $100,000 at a time, and that can exponentially grow pretty quickly. But if you're networking with individuals investing $1 million, 2.5, 5, 10, 15 at a time, they tell their friends, you can see how that can really accelerate quickly. Again, it's a network multiplier. Saying your net worth equals your network. I think that's absolutely true here, because as if you have these family offices in your network, and you can call on them for a project that directly relates to your own net worth as well. But just think about the connections that one of those family offices may be able to connect you with down the road. So it really is can be a network multiplier and very powerful. Not just from I'm going to raise capital to do a deal, but just be able to network with a incredibly high caliber group of individuals. So I just wanted to go over a little bit of statistics on family offices. This data was taken from two surveys from UBS and Campton Wealth. Campton Wealth is a family office organization. They do research. They also host family office events. They put out a survey typically every year, although I couldn't find the 2020 and 2022. Well, 2022 isn't out yet, but this is 2019's and 2021's. As I mentioned earlier, the average net worth of a family office is $1.5 billion. 9 out of 10 family offices wealth grew during the pandemic. That's not too surprising. 46% are seeking new investment opportunities. So you could say the majority are not seeking new investment opportunities, but still 46%, quite a few are looking for new operators and new investment opportunities. Also, the trend of family offices is quickly growing. Now, this is a 2019 statistic, so this number has increased, I imagine, since over the past few years. But just in 2019, 68% of family offices were founded after 2000. That's only accelerating. But how do these individuals, these families, actually make their money initially? 21% from finance and insurance, 16% from manufacturing, and then 14% made their wealth through real estate. And I think that's a really important statistic, as quite a few family offices are very familiar with real estate. They've built a real estate company. Maybe they're more passive investors. Maybe they're still somewhat active, but they're making limited partner investments or JV investments. But quite a few have direct experience investing in real estate and owning real estate. In terms of what family offices are investing in, not a big surprise. The biggest percentage is public equities and stocks, coming in about 32%. Private equity, which includes some real estate, when you break it down, is at 19%. And then just real estate in general is at 17%. So very large allocations, especially compared to other individuals. They're making large allocations to real estate. And the majority of those allocations are obviously not their single family home or their primary residence, but it is in commercial real estate investments. 94%, and this is from 2021, 94% plan to maintain or increase their real estate allocation in the future. And multifamily, in terms of real estate, multifamily is the most popular sector by far at 88%. Industrial assets are also quite popular, and then it diverges from there. And this is the 2019 allocation. And you can find this, again, Campton and UBS put out this report. If you go on Campton's website, they may have you, they'll try to get you to pay for the report, but you can find it on UBS's website for free. Or if you just Google family office study or report. It's about a 90-page survey. It's got a lot of great information, and a lot of it is geared towards multifamily offices, real estate investment advisors, but it gives you a lot of granular detail on who family offices are and what the makeup is. But again, just showing real estate makes up quite a bit, a percentage, 17% direct investments into real estate, and that doesn't include some of the real estate that's being invested in private equity funds as well. A couple commonalities, and again, not every family office is the same at all, but there's a few things in common that I've noticed over the years and in discussions with family offices. And I've had probably, I'm trying to think of how many good conversations I've had with family offices and how many family offices are currently investing with us, but no one size fits all. Some family offices, especially family offices, for example, from Latin America, for example, have a very different risk and return profile than family offices in the U.S. or Europe or Russia. I learned recently, talking to quite a few family offices from Latin America, that typically, again, not always, but typically, they're looking for shorter hold periods, strong cash flow. Looking for a higher velocity money with a shorter hold period versus a lot of American family offices that are really looking for a longer term hold period. In general, though, family offices are always looking focused on wealth preservation. They are risk sensitive. That doesn't mean that they're necessarily risk adverse, but they can be very risk sensitive. And oftentimes it comes down to whatever the patriarch or the head of that family office is concerned about at the time. So you can get sometimes very logical, sometimes irrational opinions on risk, but in general, they tend to be somewhat risk sensitive, and identifying those pain points and concerns with the market or the macro economy are important to understand when having these conversations. Highly relationship focused. I mean, this goes without saying. It's a very long sales cycle to build a relationship and trust with a family office. They really like to keep their circles relatively close. They like doing business with people that they know. And then once they like doing business with someone, they want to continue to work with that group over and over again. And they're not necessarily eager to jump out and find a new operator. And they can be very closed off. The other thing they like, what I found is, and this is all investors, without a doubt, but all investors, and especially family offices, they're really interested in opportunities, investments with a story. Obviously, it has to be backed by empirical data, good underwriting, a good business plan, but having a good story or something that's unique. Because as you can imagine, family offices get pitched ideas all the time, every single day. And some might be looking for a relatively boring investment, but you at least have to be able to express that investment and tell that story in a way that gets them interested. And because they don't have to do anything. That's the thing. They could put their net worth in bonds yielding essentially nothing and be fine for the rest of their life. So you're going to have to get them really kind of excited and motivated to make an allocation and to take the time and effort to go down the road to do due diligence with a new operator or manager. And then one thing I think is just worth noting is to watch over the next decade or so, the largest transfer of wealth in, I believe, human history, which is the transfer of wealth from the baby boomer generation to the millennials and the Gen X generation and a little bit of the Gen Z generation as well. This has already begun. We're only going to see that accelerate. And in terms of family offices, we are going to see the next generation take over control of these family offices, and we're already seeing that today. Okay, let's talk a little bit about single family offices versus multifamily offices. Now, if you're a real estate investor and you're a multifamily investor, this starts getting very confusing, especially if you go to one of these conferences when you're focused on multifamily and everyone's talking about multifamily, but it's not the multifamily you're talking about. But single family office, it's probably what you're thinking it is. It's an individual family, an ultra high net worth individual. Oftentimes they have a net worth over 100 million, but there's really no There's no specific definition, but oftentimes net worth is over $100 million. Again, average net worth is $1.5 billion. This can be simply an individual and either one employee or an actual family really just managing their own money, their own assets, and operating like an independent investment company. But they're investing their own capital and their own money. They're not taking outside investors, or they're not managing others' money, which gives them a high degree of discretion on what they would like to invest in. Single family offices can be, again, as small as one individual. They can be entire companies with staff, with 50 staff members, analysts, advisors, attorneys, accountants. Really the sky is a limit. And oftentimes, single family offices emerge out of existing operating businesses. So if an individual who's relatively ultra high net worth, they starts making quite a few investments, they may run a lot of those investments out of their existing operating business, but really they're just managing their own money, and the operating business becomes a part of that single family office. Now, multifamily offices are different. Multifamily offices there's two kinds of multifamily offices. One type of multifamily office is run by an actual family themselves. Oftentimes, a family starts a family office, and they realize it's pretty expensive to have staff, and they have quite a bit of resources. So they end up partnering with another family to share resources, or one family office starts kind of this process and eventually brings other families inside and manages their own funds. So that's really kind of the family-driven multifamily office. But then there's also the multifamily office that is much more, that's not necessarily founded or run by a family or individual family member, but it's run much more like a real estate a registered investment advisor. They're really RIA firms catering towards ultra high net worth individuals, often offering a suite of services. So not just investment advice, but all kinds of really kind of boutique services, whether that is arranging travel, paying bills, setting up insurance, anything you could imagine to really take care of families' finances. A multifamily office will have all of those services in-house, or they can at least find those services. And if you think about it, if you're a family that has moderately high net worth, I mean, let's say you're worth $50 million or so, which is you're incredibly wealthy, but maybe you don't have the resources to hire a full-time staff. A multifamily office is much more cost-effective for many ultra high net worth individuals. One of the advantages of multifamily offices from a capital raising perspective is that you no longer just have access to one family or one investor. You all of a sudden have access to their entire client base. And these multifamily offices are actively pursuing opportunities for their families or for their clients. And so they are often much more open to opportunities and open to new operators, and slightly less closed off than some of the single family offices can be itself. And so getting in with a single family office may be more difficult. It may be more programmatic over time, but multifamily offices can also be a really interesting strategy because, like, for example, we work with a multifamily office based here in Indiana, and once essentially their underwriting team and their investment committee signs off on a project, they'll bring that investment to their clients and make a recommendation that they make an investment of X. They'll come back to us with a commitment of X million dollars, and they essentially handle most of the investment onboarding process internally. Even though we're invested directly into our projects, they handle the paperwork, kind of deliver it with a nice wrapped bow, and can be a really nice situation. I just want to back up real quick because I believe I've missed a slide that is very, very important, and maybe the slide got lost, which is challenges of accessing, and maybe I just deleted the slide. That's okay. The challenges of getting in with a family office. Family offices can be very intimidating to start a discussion with. They're very closed off. There are often gatekeepers, whether these are these multifamily offices or just they're very private individuals, and so they're not looking to be solicited for investments. And if you just send them a cold email or a cold call, there's not a high probability that they are going to want to invest with you because they're getting hit up every single day by people wanting to invest in their project. There's also a series of gatekeepers often involved. It really takes an introduction or a mutual acquaintance to really make that introduction for it to be a successful introduction and relationship. But there are some ways around it, and there are some strategies to access these networks. So there's really two methods that I want to talk about. One is kind of your classic country club method, and this is going to the places where these individuals may be, whether it is where you're located, you're traveling. It's really just classic country club method of networking. Another way is volunteering or serving on boards. And again, this is just a good thing to do in general. But putting yourself in the situations and the locations where you may run into these individuals at a more chance basis, and so it's not as forced. And then building a relationship with these individuals first before you make a solicitation to, hey, by the way, I'm a real estate investor raising money for a real estate project. That should come down months after you have an initial conversation. You obviously want to become friends with these people, really with them making an investment as an ancillary thought. You really just want to try to make these individuals your friend. There is a high-end networking. This is going to, whether it's a Formula One event, sporting events. This could be effective. I think it's a low probability, but certainly going to where family office members may be is a good option. But then just old school networking, the more people you talk with, again, your net worth is your network is your net worth. But also new school marketing, and this means like LinkedIn and social media. I think there's a perception that family offices don't use social media, but that's just not the case. I've made connections with family offices on LinkedIn, on Facebook, on Instagram. Now, they're often reaching out to us. We're not usually reaching out to them. We're typically providing content or information or putting something out. They see what we're doing, and then they get in touch with us. Again, letting them come to us seems to be a much better approach than just pursuing and messaging anyone with a family office in their LinkedIn description, because again, they could just not actually be a member of a family office, and they're getting those solicitations every single day. But if you're really serious about this, you say, I want to network with family offices. This is a strategy I want to pursue. There is kind of a pay-to-play option. And I've gone down this road as well as just the more traditional networking options. There are a handful of conferences, meetings, and organizers that are putting on regular events with family offices, and the quality of these events in companies are a little bit varied, and the styles are a little bit different. I'd be happy to kind of happy to talk a little bit about these different options, and this isn't an exhaustive list, but these are some of the organizations that I am familiar with. Marcus Evans, which is a large kind of conference and summit organizer. They host 3 or 4 family office summits and wealth management summits every single year. These are usually in very nice locations, nice hotels. And what they typically do, it's more of curated meetings where you're going to have 12 to 24 meetings with family offices or multifamily offices who have a specific interest in what you're doing. So they're there to find new opportunities, and they're interested in what you're doing. Now that it's not cheap, as none of these options are cheap, but that programmatic relationship, certainly has significant ROI potential if you can achieve it. Opal is another organization that puts on all kinds of investment events, real estate conferences, as well as family office conferences. Campton, I haven't been to any of their events, but they're the ones that put out that research report with UBS. DC Finance is another organization that puts on events, and then Carmo Companies is another one. I've attended events at all these organizers except the Campton events. No particular reason I haven't on the Campton, just hasn't worked out. And I would say that the quality of these events can be varied. The price points, I think the lowest price point is around, call it a little bit less than $5,000, and you can get all the way up to $50,000 for some of these events just to attend these events, just to have a handful of meetings. So $50,000 is a ton of money to go to an event, but if it leads to raising $100 million, it's pretty easy to justify that cost. And then there are also, paid intros, people who you pay them some money and they will introduce you to family offices. And again, these are the real gatekeepers. I would say all these organizations act as gatekeepers in many ways. You really have to pay to get through the gate, and there's no guarantee of anything once you get there. I've been to many events that resulted in nothing besides some good relationships, hoping that in the next few years something comes of it. I've been to other events that have been very, very successful. And again, like I'd say, just, caveat emptor, just buyer beware in terms of, pursuing some of these pay to play options. Nothing is guaranteed. Absolutely nothing is guaranteed. You're just having the opportunity to make a connection and make an impact. Okay, just a little bit on structuring deals with family offices. As on the top, it doesn't have to be necessarily any different from any other partner, from any other limited partner. Many family offices will invest as just a limited partner in your project like any other LP. Maybe they'll invest a little bit more. Like we have a handful of family offices just come into our deals as limited partners. They do $1 million per deal. That's just what they do. $1 million every single project, which is great. Others, though, really they either prefer or they will only do a co-GP project where they want to invest as a general partner. They want a slice of that GP capital stack. Others want to invest as a joint venture partner. They're going to typically take the vast majority of the equity for a project, which can be great. But along with, like the co-GP structure, there can potentially be some strings attached, such as requiring major decision controls or other rights and provisions on the agreement where, depending on what they request or can negotiate, may really be able to run the deal, even fire you and kick you out of your own project if they can get kind of all the language that they want. So you want to make sure that the interest, and you're kind of getting in bed. If you're bringing on a large investor, a large family office, and they're going to require a lot from you, make sure that that's really what you want and that's worth that large check. But sometimes it can feel alluring of someone's going to write a $5 million check, a $10 million check. But if they basically want to run your business and call all the shots, maybe that's not the best way you want to build your business. So that's just something to think about. Side letters are very common in the family office space. This is essentially an agreement, not typically built into an operating agreement, that can either outline, just an agreement between you, the operator, and the family office on how your relationship may go forward. You may sign a side letter that gives them a first right of refusal on projects. Or it may just be a side letter that outlines if they would participate with you, what the terms of that participation would be. So when you find a project, you don't have to negotiate once you get a project under contract. You've essentially pre-negotiated the terms of their participation. And then 1031 exchanges. Oftentimes, family offices are large investors in real estate. They'll be selling a project and they're looking for a 1031 opportunity, and maybe an operator that can help facilitate that investment either through a tenants in common structure, or they're just they're a direct investor and they're going to take the vast majority of the capital stack itself. Well, that's kind of wraps up the bulk of the presentation. If you guys would like to learn more about Great Capital, our website's greatcapitalllc.com. You can take a look at our fund. Just go to gray.fund, and then I'm on LinkedIn pretty frequently as well. So yeah, I hope you all learned a little bit about family offices. I'm more than happy to take any questions. I'm just pulling up the chat. box right now to see what I've missed.
That was really awesome, Spencer. Yeah. Do you want me to relate some of the questions or?
Sure. Yeah, go for it.
Yeah, sure. So we have a question from actually Nelson. I think you wanted to speak up. Do you want to ask your question first?
Yeah,
Yeah, go.
Stefan, thank you, and as always, thank you for having these great guests on. Spencer, fantastic presentation that you gave, and I don't just say that lightly. Um, Spencer, if I wanted to use a keyword, one of my favorite words, strategy. If I wanted to create a strategy, what would be the top, let's say, 3 to 5 things to go after or to try to break into with a family office?
I think you need to be thinking about, what a family office is looking for in an investment in a partner. The thing that comes to the top of my mind that really wasn't mentioned in the presentation is alignment of interest. They really want to have alignment of interest with their, with their operator, with their investment partner, and to be able to structure projects that have as much alignment of interest as possible. We've been able to do that. Fortunately, just with my own family office, we typically make large co-investments alongside the project. So that's been part of the strategy to appeal to family offices in conversations with them, saying that, and again, besides Great Properties wasn't started as a family office. People started calling us a family office. And once they did, and I realized that, okay, well, maybe we could resonate with other family offices as well. And in the conversation saying, well, my family office, we're going to co-invest 10%, 20% of the equity in this project. All of a sudden, it gives them a feeling of, okay, I'm working with, someone like myself. They've got skin in the game. They've got money in the deal. Now, not everybody can, write a big check and make a large co-investment. Now, you may be able to bring a partner on that helps with that co-investment. But in general, as much as it is possible to create a high degree of alignment of interest, that would be probably the key tenet. And again, focus on risk aversion, their preservation of principal, long-term holds, and just, again, structuring your projects that would be appealing to a family office. Not that they're all looking for the same thing, but just being aware of what a billionaire might invest in, and not what a doctor who's going to invest $50,000 would invest in. So
just to kind of follow up with that, the alignment of interest. So it would be something along the lines of we're raising money, we're putting our own capital in, right? So we have skin in the game. And then you said long-term hold. What for them is a long-term hold?
It can depend. I would say anything over 5 years is relatively long. Some will say they like holding properties forever. Others, it's just they want to make sure you're not just going to flip out of it really quickly. And again, that comes back to alignment of interest. Because as I've invested as an LP, and again, if there's a IRR hurdle at 15%, and there's no limit on how soon someone can sell it, that syndicator may, if they realize, well, the quicker I sell it, the higher the IRR will be. But the family office, they may want to stay in that deal for 5+ years. And so if you have the incentive being that the sponsor is going to make the most money at the highest IRR, and that incentivizes a shorter term hold, that's where that interest can be misaligned. And I've been in projects where the operator sold after a year and a half, even though there was a lot of runway on the project, but there was a 15% IRR hurdle. Sold it after a year and a half. They got into their promote much sooner, and it was still a good return, but nothing compared to if they had held it for 3 or more years.
Mm-hmm, mm-hmm. And so it would be one would be find out the what does it call it, alignment. Gosh, I'm drawing a blank here.
Yeah, alignment of interest, I would say is the key. Regardless of family office, the particular strategy that any one family office may have may be different from the other. Again, on average, oftentimes they're looking for longer term holds, often more stable properties, stable assets, stable strategies. But again, that's not the case. And some may be looking for, higher velocity, shorter term holds, higher risk. And maybe that's just because they've got a silo that's more of a growth and high risk silo. But I think most family offices feel more comfortable with someone who is relatively risk adverse or at least understands risk mitigation versus someone who is just, kind of flying by the seat of their pants and doing the riskiest projects.
So the top 3 steps would be the alignment of interest, and what would you say the other 2 steps are, if we're going to like a strategy towards family office?
I would say, I think it depends. I think more institutional size projects are often of interest, although not always. But I would really say after alignment, having a really good story. And I'm sorry, I'm not giving you just a good 5-point list, but having a story not just about the project itself and the investment, which is important to have a good, strong story backed by empirical data and underwriting, but having a story about yourself and your firm and how you got to what you're doing, because again, like any investor, they're investing in the jockey and not the horse. They're going to invest in the operator, not a deal. And so being able to get them excited about yourself and your story is going to do a lot more than just, hey, look, I've got a deal and it's a 20 plus IRR. Returns, I think, matter, honestly, even though they always matter, they may matter the least in my experience with family offices. I was speaking to someone who works for a multifamily office recently, and he said, and I was talking about our projected returns, and he said, look, you can live and die by your returns. Like, sure, everyone can spout out 20% IRR, 17, 20, great. Everyone knows how to manipulate a model in Excel to pump out any number you want to see. I want to work with somebody I can trust. They think the way I do. Sometimes it comes down to morality, which can be tough. I mean, some people, they want you to go to the same church that they go to. And there's only so much you can do about that. I would say just being yourself, being your own person, not trying to completely fake it, but still want to resonate with them is important.
Right. So if you may interject, Spencer. So I know you mentioned like kind of like the importance of kind of your own story, right? That you relate to them, you're able to relate to them. So do you want to like reiterate a bit for our audience, like how it worked for you in terms of, like you mentioned, you started in single family flips after high school, and how did you get into your first family office investment? You mentioned you actually, Gray Capital started as a family office, you said, right?
Yeah. Well, Great Capital didn't, but after we founded Great Capital, I started, and I'd been flipping houses, and I partnered with a multifamily syndicator in Indianapolis as a co-general partner, and I started co-sponsoring his deals. And after I'd done a handful of those, my father had sold a business, and I said, hey, Dad, you should probably divest a little bit from the stock market and maybe why don't you diversify into real estate? And I think we can put together a strategy to invest with a variety of operators to build a diversified portfolio. Kind of here's the plan. Again, I didn't know what a family office was when I suggested this. But we went down that road, started investing as a limited partner and a co-general partner. And so we had a track record of doing our own deals. And then once I kind of learned what a family office was, so, honestly, someone suggested to me at some point, why don't you start talking to other family offices, see if they would be interested. And I started doing research and started networking with groups. I found a multifamily office that was local to me, got connected with them, I had a mutual connection. And over probably a 2-year period, they're just having conversations with them, seeing what they were investing in, seeing that they were investing in very similar types of projects that we were investing in. Eventually, and this is after sending them projects and having conversations and them saying, multiple rejections, not necessarily because of me or us. It may have been we were a little bit too early when we first started, but the project, or it was us at the time. But then really it was in early on in the pandemic in 2020 when we did our first deal with this multifamily office. And it was a project that was right up their alley. This particular project was a newer construction, 2018 built property. It looked great. It was a property, since it's a multifamily office, they felt good about bringing to their clients. Not everyone loves showing all of their clients a 1960s built garden style property that may throw off a ton of cash but doesn't look sexy. I've had some money managers say, I want to feel comfortable walking in the door if I'm going to invest in it. That has nothing to do with the return profile or the result of the investment. It's just preference, and that's fine. But this was a newer property that they felt good about showing to their clients, and it ended up being one of our best deals we've ever done, very fortunately. And so once we started down that path, I started attending some of these family office conferences. I actually think about it, I started really going to these family office meetings even before we did our first deal, really back in end of 2018, 2019. Just networking, and a lot of them were, I would say, mildly successful or not successful, because I got a handful of business cards, shook a lot of hands, got our name out there maybe a little bit. The successful part, though, for me is I learned what family offices were talking about, what they were thinking about, and attending some of these events, even if you don't, you're not going to get, they're not going to pull out the checkbook at the conference. They're not going to pull out the checkbook, once they get back. But having conversations with people in this space, hearing their presentations, and putting yourselves in their shoes, understanding their concerns, I felt really kind of helped ramp me up to be in the right place to understand what their pain points are, what their concerns are, and what they're interested in. Yeah.
That's a great answer. So would you say you were actually, you were essentially a passive investor before you in a way, like predominantly you had like a few like active syndications, but you were a family office, sort of. You were like a passive investor, and then you kind of started partnering with other family offices and doing projects together. Is that kind of like a fair assessment of the path? So it's kind of like having a
It is. Now we do less LP investments on the Great Properties side, and I'm more focused on what Great Capital is doing. And Great Properties is a partner, alongside us. But more of my focus is kind of our active. We are not even co-GP. We're a lead sponsor on projects, and then that's been an evolution of being more on the passive side at first. So we've actually gone the opposite direction of a lot of people have gone active and then eventually get to passive. We really were, I was active and then very passive and then got very active afterwards. And a part of that was seeing how so many different syndicators and operators were conducting their business, and learned a lot, and then took a lot of what they were doing, distilled it down, and said, I think we can do this a little bit better. Let's build out our own team and start, really ramping up our deal flow.
Hey, Spencer, Nelson here, just two quick questions. You mentioned in Latin America, family offices have a shorter window, right? Opportunity time frame. What shorter time frame is that?
Yeah, that's a good question, and I'm sure that's a not a good blanket statement for every an investor in Latin America, but that was just one trend that I discovered, and in my conversations, it seems to be the case. Yeah, 3 years seem to be kind of an average. Certainly less than 5 years seem to be relatively common. Anything over 5 years seem to be way too long, which is difficult because many of the North American, U.S. and Canadian-based family offices, they don't want to see anything less than 5 years. And so you kind of have to understand where your network is and who you're going to be pursuing, because if you have a much higher velocity investment strategy, it may work great in Latin America, in Central and South America, but it might not resonate as much with some North American family offices. Although again, there's exception to all these rules, but I would say 3 to 5 years would be typical.
And any specific reason that you find out from that?
No, I don't know if it relates to slightly higher rates of inflation, but I think a preference for just a higher velocity of money, more compounding, and again, just the idea of more cash flow. no real reason behind it. Just a couple observations.
And I have a question I think everybody would want to know. Because you're talking a much larger check size when it comes to things like acquisition fees. Can you talk a bit about that?
Yeah, absolutely. That's a good point. And I think this is related to not just working with family offices, but working with maybe a joint venture equity partner or a private equity firm. It's going to be difficult. You're not going to get away with a 2% acquisition fee, most likely. Our acquisition fees, our first project we did, the multifamily office, we had a 0.75% acquisition fee. That was because they negotiated some of our fees down. It was also our biggest acquisition at the time, and we were more focused on closing the transaction and making it happen rather than loading up the boat on fees. So lower fees in general. Now some don't care. Some just want to make sure it's market and you're not making too much on fees. Some are more familiar with your typical private equity structure of 2 and 20, 80-20 split, 2% asset management fee on invested capital. But in general, the bigger the check size, obviously more leverage, and oftentimes they'll say, they want you to be able to keep the lights on, run your operation. They want you to make some profit as well, because again, that can go to alignment of interest. They want you to be taken care of. They don't want you to have to sell soon if you're not making anything off of fees and all of your profit is from the promote. Although they want to see that the majority of your profit at the end of the day is performance based, is getting into your carried interest once you've exceeded a threshold. But in general, certainly lower is better.
Mm-hmm. Mm-hmm.
And
Okay.
so just I want
Thank
to
you.
ask a quick question if that's okay. For since you mentioned that you guys essentially were now more involved on the active side, but also family office. So and typically you said it's more like institutional kind of assets that are attractive with lower risk profile and less risk and so forth and longer hold periods. But what would that be for your what was that for great properties is family office? If you could mention kind of for our audience, let's say
Sure.
in terms of minimum deal size and hold period and
Yep.
risk profile.
Yeah, it's not too different from what we do at Great Capital, but typically kind of deal size. We've never wanted to invest in anything under 100 units typically, and that's for economies of scale and the idea that one person moves out and your occupancy rate at 100 units is going to increase by 1%. We prefer assets that are really closer to 200 or 250 units. Now, that was the family office side. I would consider probably smaller assets, and I've invested through Great Capital and just personally through smaller deals themselves. But that's really what the just what Great Properties acquisition criteria was. We were very focused on cash flow, really looking at income, not necessarily as focused on IRR or equity multiple, although certainly paid close attention to those two key metrics. But really had a strong focus on income and cash flow. Because really, again, when we were starting Great Properties, I mentioned I wrote my father, and he had sold a business, and he was looking to replace his income. And bonds weren't doing it. Dividends from stocks weren't doing it. And so one of our first goals was, all right, we got to get your income up to X. How do we achieve that? And so looking for projects that threw off cash flow out of the gate. So no new development. No major repositions, not a lot of opportunistic investments, very much in the value add, light value add, up to core plus risk and return profiles.
What cash on cash return, if may ask, would that
Yeah,
be?
I mean, typically now times have changed, and if anybody has been underwriting multifamily in today's market, year one cash flow is a little bit lower with today's cap rates. We like to say we would typically in the past like to see 7-8% cash flow close to year one, trending to double digits over time after a business plan has been executed. No, there was some wiggle room on that. If it was 6% year one, but it was trending to 9 or 10, that would make sense. And this is almost all in the Midwest, by the way, where you can get some decent cash flow. But we're really kind of 8% was the target, trending to double digits by year 3 or year 4.
So you really invest entirely in the Midwest or also some of the other markets?
Primarily in the Midwest. Again, that was driven by being in markets that we really knew and understood, and if I wanted to drive out and take a look at the asset, we could. I find it interesting. A lot of partners that we invested with, I would ask, how many of your LPs go on tours with or have ever toured a property? And Manny said, no investor has ever toured a property with us. No one's ever asked. So we like to be pretty hands-on. I also had the plan of eventually doing more of our own direct syndications as well. So I was really trying to learn as much about the business as possible. But yeah, we typically in the Midwest, we have invested in the Southeast, in Georgia, in Texas, Louisiana, a variety of. I think we've invested in over about 15 states, but the majority have been in the Midwest, with the vast majority being in the state of Indiana, just because that's what we know.
So Spencer, this is Scott. You get a conversation with a family office. And in my case, specific to open-ended single family with a twist, also in the Midwest, which is kind of weird because I live in Vegas and spent the last 20 years all over the Northwest as you did. But I grew up in Pittsburgh, so Midwest focused. So now I get that appointment and I'm working with my team right now on kind of an intro deck. And they built this thing that I come out of the sales and marketing world, and to me, it's death by PowerPoint. It's 40 slides, every number you could, and this is not including just the model. And I'm kind of thinking more 15 slides, get to the point, have all the supporting stuff available, even on a URL that you can hand off to somebody like you and say, hey, if you want to dig into this more, but here's kind of the high points. Institutional funds, I think, tend to like the massive, gross detail, make me look good with my boss type deck. But I'm just wondering, with family offices, in your experience, my guess would be kind of short, sweet, high points, tell our story, almost like you're presenting to get another opportunity to present.
I would agree. I think you've got the right mindset. We feel, at least, and we could be wrong, but I don't feel as though 40, 50 page deck, and we've had 40, 50 page decks in the past. I don't think that they're very effective. Most people skim through them very quickly. I mean, literally, it's a very quick skim. I mean, because we use HubSpot as a CRM, and so we'll send a document and we can see how long a page was viewed for. It's skimmed through, and maybe they'll stop on a page or two and read briefly. It's much more about the conversation, the idea, the concept. Okay, what's going on? Okay, move on to the next. We've taken the philosophy as, less is more initially. Like you said, it's for the next conversation. And then it's, what would you like to see? And so we've taken the strategy of creating a variety of just supplemental materials. So, here's our just initial deck that's like 12 pages or so. But if you'd like, in-depth market supplementals on the markets we're investing in, I've got a 40-page market supplemental on, Indianapolis. Then we have separate. We have a closed-ended fund. So for each project, we have a deal supplemental. We don't have each deal, in the deck. It's here's the concept of the fund, broad overview. It's really, let's have a conversation about it and some talking points. As detailed as you want to go into, we'll provide that information. We lean on transparency. And so we're pretty much an open book. And so with, frankly, a lot of our family offices, not all, but many, we know that they want to know about a deal sooner rather than later. And so we'll bring them into the conversation, one, because we want their buy-in, especially if they're an anchor investor. We say, okay, if we're going to go after this, $70 million deal, I want to make sure that you guys are on board. And so we'll share, financials, underwriting models. We'll invite them on initial tours, sooner rather than later, kind of giving them kind of the inside view, opening up the hood and saying, this is what we're looking at. This is why we're pursuing this, and let's all look at this together, kind of getting them involved in the process. To me, it's been much more effective than just sending them a deck last minute and saying, we're ready to go. We're going to close in 3 weeks. Now, so other groups, they don't want that amount of detail. They don't have the time, and they're okay with a deck. But it's usually, okay, I flipped the deck. I have a good understanding. But why don't you just give me the overview? And that's what I do typically. If I'm going to be invested in a limited partner, I'll go through the deck to understand just briefly kind of the high level of, okay, what are we investing in? What are we looking at? Then I want to have a conversation and say, you just tell me what we're doing here. What's the plan? And then started getting into the details. Okay, tell me about how you're financing it. And then maybe referring back to the deck to see if I'm missing anything. But I think that conversation and the relationship over time is what's going to make the deal happen. It's not going to be a particular, it's not just going to be your deck.
And so we have like several
Thank you.
questions in the chat. Yeah, thank you, Scott, as well. So we have several questions in the chat, and since we are kind of over time, I do want to make sure we go over them. So Jay is asking, do family offices sometimes collaborate, or could a family office take an LP position in a private performance-based fund?
Well, absolutely. There's no limit to what a family office, potentially could do, as long as it aligns with their strategy and it's kind of in their allocation profile. And you have to forgive me, I'm not 100% sure about what a performance-based. I'm sorry, I'm looking for the question so I can read it. I'm not sure what a performance-based fund is, other than if you're just talking about just your more typical private equity fund. But long story short. There's no reason why they wouldn't. So we have a fund right now. Some family offices are investing directly into the fund. We have others who we have either a prior relationship, who have been investing with us deal by deal, because we were in the past doing single asset syndications deal by deal. We allow family offices or larger investors to invest in projects deal by deal, through a sidecar vehicle or a co-invest vehicle, but we have a minimum of usually about $1 million minimum if you'd like to invest alongside the fund. Because some groups, they don't like funds for whatever reason. They don't want to give discretion to a manager. They want to build out their own individualized portfolio, and that was honestly the philosophy of Great Properties. We did eventually invest into a handful of funds, but they were more for strategies that we weren't as familiar with, and we really trusted the manager. I still do trust the manager. But typically when it came to multifamily, we would invest deal by deal in single asset syndications, but also we invested as sidecars, co-investment vehicles as a co-general partner, but investing outside alongside the fund as well. And our philosophy for Gray Capital and the Gray Fund has been, we want as much flexibility as possible. So if we do meet the right partner, we're not chained to a specific structure, and we can create that special vehicle to allow them to participate. They can't always have, it depends on the relationship. We don't typically like to give special economics to a co-investor or a family office. But we will allow them to kind of get into one deal over the entire fund.
And Mariah is asking, any thoughts on broker dealers, placements, agent relationships?
Yeah. I think there's a tool, and we have a philosophy of just having as many tools in the toolbox for raising capital, whether that's individuals, and we do our own kind of direct crowdfunding. We work with crowdfunding websites, we work with family offices, and we have conversations with equity brokers. And I found that we haven't gone down the equity broker route directly. We did a co-GP that we brought on. We used a broker for joint venture equity partner. It can be a even easier method, to be honest, than family offices, because especially right now, I think looking at a statistic, I think Berkadia released a couple weeks ago, I think there's like 240 some $1 billion of dry powder that's allocated to commercial real estate that just hasn't been placed right now. So there's a ton of capital out there. And so you can go to an equity broker, you can call them up and say, hey, I've got a deal. I'm looking for $50 million of equity, and they can call around. They can find the equity for you. Now, you have to have the track record to attract it. You're probably gonna have to find a way to guarantee the debt. And you may not like the terms that go along with that JV equity. They will probably have all the major decision rights and controls to the deal. They may be able to fire you if they don't like the way you're operating the deal. In a ton of business, in a lot of real estate gets done that way, and there's nothing really wrong with it. A lot of it's very successful. It can be very great. Again, programmatic relationships. In my experience, going down that road comes with more strings attached than working with family offices that can be a little bit more flexible. But if you are okay with some of those strings, it can be a more direct approach. Go on LinkedIn and just ask, who are some equity brokers and placement agents that and you'll be able to find some pretty quickly. And again, unless it's your first deal, there's so much capital out there that you might be able to make something happen.
Maybe if I could add a little context to that question, I've developed some relationships with placement agents and brokers, just professional relationships within private equity networks. So I'm comfortable with them, they're comfortable with me. But in your opinion or in your experience, have you seen that those broker dealers have more of those longstanding relationships with family offices? Because that's a tough part for me personally, is I don't like the relationship to be transactional when you're dealing with a family office, but sometimes if there's a pre-existing relationship, then there's more trust so that you're not dragging out, progress for the sake of building relationship, but there's also trust there. So that's kind of what.
Yeah, I think I totally agree with you. I don't like the relationship to be just so transactional, and I think that can happen with family offices as well as more private equity joint venture partners, and especially if there's a time crunch and you've got a deal under contract and you need to find a new partner and you go speed dating. It can only be transactional. I mean, you can only build rapport so quickly. If that's the only option, it may be better than not doing the deal. But if you can take the time, put in the legwork to build those relationships, that's a much better way. Because then it is more of a partnership in a true relationship than just being completely transactional. So I would say that could be the case either with family offices or with equity placement agents and private equity firms, and that's where putting the time in to be really important.
Ramesh is asking, what kind of analytics numbers do you feel a small family office would look at the closest when you send them a multifamily deal other than cap rate and IRR?
I would say no real differently than no special KPIs. Now everyone can have their different metrics they look at. I know some are really focused on yield on cost. They want to see yield on cost trending to at least 6% or 8% over by a certain period. It may be cash on cash return. There's not one, and it's really not any different than any other investor who may have a preference or a weighted preference towards more cash flow and income or appreciation and growth.
Yeah, I only asked that question just because, for example, like a smaller family office, if you've ever seen that they value other things other than just straight profits, such as the condition of the property. Is it like an A-class property?
Yeah.
Is it something that is going to require, them to stress out at night about the investment, about all the repairs, about the kinds of tenants that are, not paying rent and haven't been for months. So I was wondering if you've ever ran into that where they value things other than just like potential upside.
100%. And we did a deal like that a couple of years ago where it was very attractive because it was a nice looking property. And they're like, wow, okay, I could see myself living there. I could have my kids live there and I could walk in there and I'd be great. And then this was a multifamily office. They felt comfortable showing that property to their clients because there is a pride of ownership of, you're investing in this, beautiful, trophy asset versus, this thing, it doesn't look pretty, but it's going to throw off cash flow. So it totally depends on the investor. So I would say maybe a multifamily office may lean towards kind of the nicer A-class, more institutional product, but maybe some single family offices, they get it. They understand that you've oftentimes, not always, often, if you're going to invest in an A-class asset, you're not going to get much cash flow. You're more focused on cap rate compression. They're a little, just again, in general, just a little more seasoned and maybe sophisticated. And so they don't care what it looks like. They're really focused on cash flow. And I know some family offices that are like, we only want distressed properties. The rougher the better, because we want to trend to 12%, 15% cash on cash, and by year 3, then we're going to refi and move on to the next. So it totally depends, who you're working with, and again, their own risk appetite. Which again, it's important. There's no one size fits all. Although there are some commonalities that I've found.
And like, so just like several more questions before we wrap up, if that's okay, Spencer. I really appreciate taking the time.
Absolutely.
So Danny is asking, so with the multifamily office being comprised of an entire team, is there a particular job title that may be best to build a relationship with, a senior, RIA, or other?
I think it depends on how they're structured. It really depends on how they're structured. So like with one multifamily office we work with closely, I started the relationship with the principal, and they eventually brought on someone to run all of their real estate holdings and their real estate investments and help with their underwriting. And now I coordinate primarily with that individual, but I still reference back to the principal of the company. I think it depends on how large the multifamily office is and where you have access to. Obviously, like any sales, speaking to the decision maker is always going to be a lot more effective rather than someone who is doing due diligence to bring that information to an investment committee. But you've got to start somewhere.
So Tony is asking, what are your thoughts on qualified opportunity zone funds and family offices investing in qualified opportunity zone businesses with new commercial real estate?
Yeah. I mean, the QOZs are, very popular investment vehicle for family offices. I mean, anytime, I haven't spoken to too many family offices that enjoy paying any more taxes than they have to. And so if they do have, some significant capital gains, tax liabilities, especially if they're selling an operating business, and this is where I've really seen it come into play, if there's a sale of a, long-held operating business, deferring those capital gains and eventually eliminating them through a qualified opportunity fund or qualified opportunity zone can be very, very attractive. That hasn't been our focus, just because, again, we've been mostly focused on cash flow out of the gate and existing assets. And typically the opportunity zone regulation it eliminates that type of strategy, because typically you're having to put a significant amount of capital into it, typically a ground up development. But there's just being at these. I've been asked to sit on panels about qualified opportunity zones at family office conference, even though I'm not an expert in opportunity zones. So it's been a very popular topic, and I know a lot of family offices have been investing into QOZs.
And so what about, so Mariah did a question about actually, so curious if qualified small business stock, QSBS, is compelling to anchor or lead investments.
That's outside of my that's probably outside of my wheelhouse. So I'm not as familiar with qualified small business stock. I'm sure it could be though, but I don't have enough information to give a good answer. Sorry.
Okay, sounds good. And so then last question, Evan, I think you wanted to maybe speak up, if that's okay. Yeah.
Hi.
Evan?
Yes. Hi.
Evan.
Thank you very much for taking that, Spencer. Very, very informative. I appreciate it. And as I just wrote real quick, I just took over. Family office. We're multifamily developers in New Jersey. So we're in the UEZ zones. We are we own about 2,500 apartments, but I'm on the other side now on trying to look for other investments. We do have the real estate. And I just wanted to see, Spencer, what you've been seeing, and do you get that deep with your potential clients on their ratios of where they put their money? Do they say, hey, I want 25% real estate? Do they do 10% art? Are they looking at NFTs? Have you seen any kind of different avenues besides real estate, even though I know real estate is your forte. I just wanted to see what you've seen out there.
Yeah, that's what I find most interesting going to some of these events, is seeing what everyone is looking at and paying attention to. Certainly, cryptocurrencies have been top of mind at the past few kind of events that I've attended to, or just in conversations with family offices. Art has also been fine art has been also very fast growing asset class that like a ton of family offices I know haven't been, I mean, obviously investing for generations, but more popular, at least than it seemed like it has been in the past. Opportunity zones have been popular. Private lending has been quite popular at the past few conferences that I've seen. Real estate is always popular. And in terms of allocations, it is interesting. Oftentimes, and for specifically, I've attended some of the Marcus Evans events in their kind of family office group. And it's a really interesting model because you kind of get paired. It's a little bit like speed dating, but you're paired up with a family office or multifamily office that is interested in what you're doing. But they have profiles of every single attendee, every single family office and multifamily office, and they typically in their questionnaire ask what their allocations are. Allocation to real estate, preferred return metrics for real estate, other asset classes.
Wow.
Real estate is definitely a commonality, but it's the sky's the limit. A lot of other unique option strategies I've seen. A lot of this is fixed income proxy to be able to generate income. Typically selling spreads or some. I'm not an expert on derivatives or options, but really
Right.
just trying to create additional income streams or just a handful of other opportunities I've seen. They've been interesting.
I appreciate that. You did say private lending. You do see that. And when they do private lending, you mean they have to, is it like an exact deal, or someone might say, hey, I'm looking for X amount of money. I'm looking to get a 7-8% return and, sign it to a term sheet.
Yeah. I'm not read in enough. I know that it's been talked about quite a bit. There are a lot of managers that were facilitating private lending. I think a lot of times it's pooled, obviously, again, looking for some kind of yield, but I haven't really kind of dipped my toe into it. Just knowing that quite a few family office were interested in it, and I'd highly recommend it if you want to get into kind of more granular information on that. Though I would look at that UBS and Campton report and survey that they did. I think they survey around 500 family offices from around the world, and they break down what their allocations are and what the trends are. And on the 2021 report, the trends were unsurprisingly, cryptocurrency was really the biggest one. This is probably, I think NFTs was on there, but private lending was also a major trend as well.
That's UBS and Campton, CAMPTON?
CAMPDEN. Let me go back. CAMPDEN. This Camden Group. Yeah, absolutely. And again, the report is free somewhere on UBS's website. Campton, I don't know what they're trying to charge for it, but they are charging for it.
Okay, so I think we went over all questions, so that was really, really great. Thank you, Spencer. Appreciate your going deep on all those, all the topics and putting the time tonight here with us. Thanks to everyone for joining us as well, and have a good night.
All right. Really
Thanks for
appreciate
putting it together. Appreciate
Thanks,
your
everybody.
time. Thank you.
Thank you, Spencer. Thank you, Stefan.
Absolutely.
Once
Have a good
again,
evening, everyone.
Just once again, best way to reach you, Spencer?
Best way to, I'm on LinkedIn. You can, LinkedIn / Spencer Trevor Gray. Our website's graycapitalllc.com. And feel free to shoot me an email, Spencer@graycapitalllc.com. And if you're interested, I'll just pop it up. And if you're interested in learning more about our fund, Midwestern Multifamily, you can just go to gray.fund and get the sign up for the pitch deck there.
Perfect. Thank you so much. Have a good night.
All right. Thanks, guys. Have a good one.